Hello and welcome to FidelityConnects. I'm Pamela Ritchie. As we approach year-end, advisors are navigating crucial deadlines that can impact client portfolios and tax outcomes. From RESPs and our DSPs contributions to RRSP strategies and FHSA opportunities, timing is everything for these acronyms. Are you helping clients optimize their TFSA withdrawals before the calendar flips? And what proactive steps can position them for success throughout 2026? Joining us here today to unpack some of the strategies surrounding these very important acronyms is Fidelity Director of Tax and Retirement Research, Jacqueline Power. Great to see you again, Jacqueline. Welcome.
Thanks so much. Really happy to be here.
Delighted to have you here, particularly at this time of year, because this is actually where it all hits, doesn't it? This is obviously the calendar flip. Yeah. We'll invite everyone to send questions in for Jacqueline over the next half hour or so. Let's talk about all the things that happen at year end anyway and always.
Yep. What's
new though? There are a couple of circling things that have been either out of the budget, are they important, or are they not? The trust story seems to have evolved and then devolved and then evolved and then devolved. Tell us a little bit about what's a bit new this year.
Yeah, for sure. So I would say as far as the Bear Trust rules are concerned, we have a little more an idea of what's going to happen in the future, which is quite nice, and a lot more exceptions, which is great. So first and foremost, important to know that as far as this reporting is required.
And it is, just to sort of...
Pardon me?
And to actually sort of define it, a bear trust is.
So essentially a bear trust is a situation where there's an individual who is a legal owner, but not the beneficial owner. So where we see this is really quite common would be situations like an in-trust for account. So parents set it up for a child, the money belongs to the child, but the parent is the one who is legally the owner, but they're not the beneficial owner of it. So essentially what the government did a few years ago is they were trying to, they threw this net out, and it just went a little too far, and they pulled in all sorts of trusts and were requiring reporting as far as some of these trusts were concerned.
Did they want to know what was in them?
That's exactly. They wanted to get a sense for who the beneficiaries were, what assets were in there, that sort of thing, how large some of these accounts were. That was what they were trying to get a sense for. And then essentially what they realized is they went way too far. And in many circumstances, it just ended up being a situation where, tiny little trusts were contacting CRA to get a trust number so that they could file their T3 trust return. And then essentially what happened was that at the 11th hour, like right before all of this reporting was to be done, the government said, okay, we don't need to do this reporting. So then they kept pushing it off. They pushed it off to December 31st of this year. And now they've pushed it off to December 31st of 2026. Okay. So they've also provided many more exceptions. So there's so much more clarity with respect to that. So if we're looking at a small trust, so $50,000 or less in assets, it can be invested in anything. The trustee does not need to be related to the beneficiary. In that situation, the reporting is not required. Also, another thing that is a trust where individuals are related. So, parents setting it up for child. In that situation, now it's $250,000 is the amount that can be in that trust. It can
without reporting.
Exactly.
Okay.
And it can be invested in anything, but the trustee needs to be an individual, and that individual needs to be related to the beneficiary.
Meaning it can't be a numbered company or something like that. Okay.
Exactly. Another thing that's really nice too is with respect to real estate, in particular principal residences. So they've made an exception with respect to that as well, because what was happening was a lot of parents were being added on title on that principal residence for a child, simply to help the child get the mortgage. And
they were just underwriting the mortgage for them?
Exactly.
Okay.
So essentially, what was happening there was that was being lumped in with these Bear Trust reporting rules as well. So now that's another exemption. So as long as the two individuals are related, it's the individual's principal residence, then in that circumstance, the reporting is not required there either.
So it's going to be less onerous, and it's next year.
Exactly.
Okay.
Exactly.
So that's the new, and that's sort of, I guess, the good news for those that are concerned about that. So that said, we've got the end of the year approaching. We're in December. We go through all of the deadlines for all of the different government type investment vehicles that allow you to be more tax efficient in the way you invest, where you save. Let's go through them. What is sort of first and foremost in your mind? If you had to pick one, what is the most important?
So what I would say is understanding trade deadlines is really important.
Okay.
So anything that advisors want their clients to have sold, that transaction needs to be done by December 30th, so that it can settle by December 31st. Because if it pushes into the next year, then it's going to fall into 2026. Where some of these deadlines are really important is if we're looking at like an RESP, for instance. Yeah. So in that circumstance, if somebody wants to be able to receive grant for 2025, again, that contribution has to be made by December 30th in order for them to be able to receive the grant. Where RESPs are interesting and sort of different than some other account types is if a child has never opened an RESP or or hasn't received grant by the age of 15, that contribution needs to be made by December 30th of this year in order for them to receive grant. Because if they don't receive grant the year that they are 15, even if they make contributions when they're 16 or 17, they won't be eligible for grant at that point. Okay. So that's definitely something that's important. Our DSPs as well, the Registered Disability Savings Plan, again, it follows year end. So if somebody wants to receive grant, that contribution needs to be made by December 30th, so it settles by the 31st. And then if somebody's 49 this year, that's the last year that they can make contributions to the RDSP and receive grant for that. So again, they want to be cognizant of that as well.
That's really, really interesting. And you haven't even mentioned RRSPs in there because, of course, their deadline's a bit later, yes. which is part of it. But in terms of, should we go next to those that are thinking of buying a house in the next year or wanting to save for that? Perhaps they've already set something up. But again, what do they need to do going into year end? Yeah,
for sure. So with the FHSA, so that's been available since 2023. So if somebody's eligible for that, essentially they have to be age 18, have to be considered a first-time home buyer, and then they can set up this FHSA. With respect to that, annual contribution amounts are $8,000. Lifetime contribution limit is $40,000.
Does it help? Do you like this vehicle?
I really like it because it's a combination of the TFSA and the RSP. So what I mean by that is when contributions are made to the FHSA, like an RSP, you get a deduction for that.
Right.
So a lot of the time these, are being set up for young Canadians. So they may not want to use their deduction in the year that they receive it, and they can carry that forward indefinitely. So that's something to keep in mind as well.
So when they do make more and their tax rate is higher, then they can have it
Exactly, because it would be more powerful to them at that point, for sure.
So it's interesting. So there's that vehicle, which, as you say, is recently set up in the last 4 years. But then you've always had the piece of the RRSP that you can go into and dip into for buying your first home.
For sure, most definitely. So that would be the home buyers plan.
How do they compare?
So they actually complement each other.
Okay.
They really do, because it's allowing individuals to now be able to take more money out. So with the home buyers plan, it's $60,000 that they can take out.
Of the RRSP.
Exactly. Yeah. And they're essentially borrowing money from their own RSP. So when it comes out, there's no tax that applies at that point, but then they do have to make repayments. So normally repayments start 2 years after the withdrawal is made. So normally at this time of year, we're saying, if somebody's buying a house in 2026, normally it would make sense for them to wait until 2026 to make the withdrawal, because of the fact that you have to start payments 2 years after the withdrawal's made.
Got it.
But this year's different. So essentially what the government did is a couple budgets ago, they extended the repayment period. So they said if purchases were made between January 1st, 2022 and December 31st, 2025.
So this is kind of coming out of the pandemic. This is the years where things have been all a bit up and down in terms of how people were contributing, making money, and so on.
Exactly. So they wanted to give people just a little more time. So if somebody makes a withdrawal by December 31st of this year, instead of having to start those repayments in 2027, they have an extra 3 years. So they don't have to start the repayments until 2030. So that might be a time where it goes against what we would normally say, like to wait until January. This is a year where it could make sense because it's pushing that that repayment out.
It's really interesting. And you wonder how you go across the country, across the province to speak with advisors all the time. How many questions do they get about all of these different vehicles? This must be a massive time of year, of course, for advisors for lots of different reasons, but on some of these particulars that are different.
Oh, for sure. This would definitely
ago.
be something, especially with, so many people wanting to purchase homes, but are finding it difficult to come up with money for down payments, that sort of thing. Yeah. This is allowing them to have two vehicles, right? Because with the FHSA, if they end up, maximizing that account, that's $40,000 plus any growth. And where I was saying that it's similar to the TFSA is when that's withdrawn, there's no tax. If it's a qualified withdrawal that's being made for, then there's no tax that applies.
Because you've been taxed on the way in.
No, so you're not taxed at all.
Period.
Exactly.
Good.
Now, if you're withdrawing money and it's not a qualifying withdrawal, so maybe you're not purchasing a home, then in that situation it is going to be taxable. Sure. There's also a provision that says that if somebody doesn't purchase a home within the 15 years that the account can be opened, they can actually transfer that on a tax deferred basis into their RSP, and they don't need RSP contribution room. So that's why I was saying it's a good account for somebody to have. Now, where they need to be careful is when they're opening the account, they have to think about when they're planning to buy a house because of the fact that it can only be open for 15 years. So if somebody's 18 years old, they don't think they'll buy a house until 35, they should wait a couple of years before they actually open it.
And at 18, who knows?
Well, exactly.
But in any case, but as you say, you'd be advised, and the advisors will go ahead and do that. I'm curious about when you're talking about homes and houses and different vehicles and what you do at the end of the year, how much money is flowing from advisors working with the parents, going to the kids to sort of help get some of these things going? A lot of this is generational, and certain investors, if they're young, wouldn't know about any of this, except for their parents would let them know, and those advisors attached to them.
Very much so. So I think a lot of the time with an 18-year-old, they're not going to be aware of the FHSA or the home buyer's withdrawal. So it is something that, and I always encourage advisors to start to build that relationship with the next generation as early as possible, right?
How do they do that? I mean, we've had lots of discussions about this, but do you have any, are they taking someone out to the driving range, or like what are you doing with an 18-year-old?
It all depends, right? So I think it would start as inviting them to meetings with the parents, right? And just starting to build that relationship, because I mean, there are so many studies that have been done that are talking about, once the parents pass away and the money goes to the next generation.
It goes to the next,
exactly. If the advisor doesn't have a relationship with the next generation, then they're going to lose those assets. So the earlier you can start to build that trust with them and have that strong relationship, the better.
So you do see some of that. So going to the TFSA, which has been around for some time now, we know what the amount is. I think it's $7,000 for next year. Do you like this vehicle again, and what do you find it's used for the most? I mean, for short-term savings, long-term savings, like how does it work?
It really depends on, for all of those. Yeah. Like it really depends on the individual. People like to have it as an emergency fund for many people. I mean, the great thing is that it's tax-free, right? So the fact that you're able to have this money that's growing tax-free is amazing. If people have never opened an account and they've been eligible since 2009, they have $102,000 that they can contribute to the account. So it can be really powerful. Sometimes we'll see it used for people who are worried about net income, OAS clawback, that sort of thing. So a senior who wants to go on a trip but doesn't want to affect their net income, they could make a withdrawal from the TFSA. It's not going to be taxable. It allows them to have this extra money and not have to worry about, OAS clawback or anything like that.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Would you say that there is anything further on sort of knowing about this FHSA in terms of ongoing? So they've expanded things, they're making this easier. We're also hearing a lot about government programs to build more housing. I'm sort of curious about what you hear on the affordability of houses generally. This is basically impossible in most cases. We keep hearing it might become easier. There are certain portions of the market that are not doing well. What is the discussion there?
Yeah, and that's it is still really difficult for young Canadians. You know, I worry about my kids, and are they ever going to be able to purchase a home? So it is nice to see that the government is putting these programs together to try to make it easier for people to have down payments, that sort of thing. Because like if they are using the FHSA and the home buyers withdrawal together, that is $100,000 plus whatever growth could be in the FHSA. So that is then, you know, if you have a couple, that's $200,000 that you have as far as a down payment is concerned. So that can be really quite powerful. And the nice thing with the FHSA is they don't have to pay that back, right? So it's not the same as with the home buyers plan where, you know, they have to pay 1/15 of it back over,
along with their mortgage.
Exactly, right? And now with the home buyers plan, if for some reason maybe their income is low and as a result they decide that they don't want to make a payment in a particular year, what happens is that's then taken in as income for that year. So they have the opportunity to do that if they happen to be in a low tax bracket. So sometimes we'll find that with couples. Maybe one is a stay-at-home parent, and for them, sometimes it makes sense for them to take that payment as income rather than actually making the payment to their RSP.
So let's talk about RSPs. It's obviously a longer deadline, so it's not something that happens in a matter of weeks. But that said, there's the contributions, there's the switching over to a RIF account at a certain age, at 71, I think it is. Tell us a little bit about, you know, what you want to be thinking about now, just in terms of that deadline approaching, but not for a couple of months.
Yeah, for sure. So essentially, a couple of things. Like they do have the first 60 days and to make those contributions. They can choose if they want to use it in 25 or 26 if they made it in the first 60 days of 26. This year, that falls on a Sunday, so it's actually until March 2nd that they have to make those contributions. Okay. So that can be helpful. Now, you talked a little bit about, you know, turning your RSP to a RIF
when
at
that
71. So with respect to that, what we're finding is more and more Canadians are working past age 71. Right? So you're still accumulating RSP contribution room, but you don't have an RSP. So say, for instance, there's somebody who's turning 71 this year, still has earned income for 2025. So theoretically, they could make an RSP contribution in 2026, but they won't have an RSP in 2026 because of the fact that they have to convert it.
Right.
Exactly. So what some individuals will do is it's called a seniors over contribution. So they'll make one last contribution in 2025 based on what their contribution room is for 2026. So it puts them into an over contribution position. There is a penalty that applies. It's 1% per month. So that's why they would do it in December instead of doing it, you know, earlier in the year. But then the nice thing is come January 1st, that over contribution disappears because they have that RSP contribution room from their earned income this year.
So that's just a 1-year thing and sort of a transition changeover type thing. Then after that?
So then after that, they're, well,
if you're earning income, I mean.
Yeah, so if they have a younger spouse, then they could contribute to the younger spouse's spousal RSP. And that could be an opportunity for them as well. So but if both spouses are 71 and both spouses continue to work, unfortunately, they don't have an opportunity to continue to make those RSP contributions.
It's really interesting. Anything else to know when you take a look at the spouse, or even if it becomes a RIF, so you get to that point where both are 71, and the attribution there, let's go into that.
Yeah, for sure, because that's something that's really important. So essentially, any time that somebody makes a withdrawal out of a spousal RSP, if contributions were made in that year or the previous 2 years to a spousal RSP, any amounts that are withdrawn end up attributing to the contributor. So that defeats the purpose of what they were setting it up for. So what you want to do is make sure that you're very cognizant of when the last contributions went in before withdrawals start. Now, there is an exception. So if they RIF, and they make the minimum withdrawal out of the RIF, even if contributions went in the 3 years before that withdrawal, it's still going to be taxable to the individual who made the withdrawal. But if they withdraw amounts above the minimum, then that would attribute back to the contributor.
Can't the withdrawal just be made by the other person? I mean, isn't that... how you would
So
do
the
that?
withdrawal is made by the annuitant of the account.
Yeah.
Yes. But if that withdrawal is above the RIF amount,
I
the
see.
RIF minimum, that's why it would attribute back to the contributor.
So something that happens perhaps a little bit before you get to the point of switching things over to a RIF is the splitting, the income splitting, and how this works ultimately. This is annuity payments for DB or DC, so a couple of different types of pensions. Yeah. Do we have many of those pensions left?
So not as many.
No.
There are still some, but yeah, to your point, not as many as
they don't exist
as there
in
were.
the same way.
Yeah.
So let's talk about income splitting, because
Sure.
that's a very useful tool for a lot of couples.
Oh my goodness, definitely. So with income splitting, it's weird because there are different rules depending on whether it's pension income that somebody's receiving or income that's coming from a RIF or a LIF. So let's talk about pensions first.
Sure.
So with that, it can be split at any age. So once somebody starts receiving, their pension payments from, say, a DB pension, up to 50% of that can be split with their spouse. So essentially, the nice thing is that it's done right on their tax returns, so they don't have to contact the financial institution and ask them to do the income splitting there. It would be at the end of the year, they determine what both spouses have as far as income is concerned, and then determine how much, like up to 50% should be split. So the idea there is instead of having one spouse with a really high income, another spouse with a low income, it'll be a little more even between the two of them. Right. So help from a tax perspective as far as the family unit as a whole is concerned.
It's really interesting, and something to be able to do that is really helpful. A couple of questions that have come in. Some of them circle back to things that you've touched on, but just with more detail. Do you have to have the funds in an FHSA or an BP for 90 days before it can be withdrawn? Actually, they have different days.
Yeah, they do. So the home buyer's withdrawal, it does have to be in for at least 89 days. So that's why at day 90, that's when the withdrawal could be made. The same rules don't apply for the FHSA. So there's no minimum period of time that the money needs to be in the FHSA before it can be withdrawn.
I mean, would there be a reason that you just put it in for a hot minute and take it out?
To get the deduction.
Okay.
Yeah.
Okay, so that does happen.
Yeah. Oh, yeah.
And that's used properly. Okay, great. Question. Another couple of them. Do you have to pay back the FHSA withdrawals after a certain time? You touched on this too.
Yeah, so you do not. So that's the great thing with the FHSA. Does not need to be paid back.
And this one is, I don't know if this is too specific or not, but let's ask you, if you don't buy a house within 15 years, can a client roll the funds into an RRSP and then open a new FHSA? You can roll them in.
You can roll into an RSP, but you wouldn't be able to open a new FHSA.
Okay, so that's that 15 years. You really want to be cognizant of whether that's possible for you to buy a house inside of that. Those are great questions, all of these coming in. Let's go into charitable donations through the end of the year. A lot of people do this at the end of the year for lots of good reasons. Is the timing all the same? You got to be there on the last tradable day of the year to make sure it goes through and settles?
Exactly. And this, so if the donation is not settled by December 31st, they won't get their donation receipt, and as a result, won't get the credit. I would also recommend contacting the charitable organization if they want to do an in-kind donation, because some of them will so that's if you're donating securities,
stocks,
exactly, stocks, bonds, mutual funds, anything, as long as it's being donated in kind to charity, the capital gains inclusion rate on that is 0, plus the individual gets a donation receipt for the full amount. But the reason I was mentioning that is because a lot of the time the charity will have a cutoff date before December 31st because they need to be able to settle that trade. So they'll need some time to do that. So I would just encourage advisors to encourage their clients to reach out to any of those charitable organizations to see what their cutoff date would be for in-kind donations.
I'm just curious, do they tend to settle them right away, or they might not? I mean, they might hold them as shares.
I'm not sure how it would work from their perspective. And as far as the individual is concerned, whatever the value is at the time that it ends up being donated to the charity, that's the donation receipt that they would receive.
Anything new about charitable donations? They've actually gone through a few years where there's been lots of audits and concerns and worries. Would you just have a piece of advice that you'd throw out there? I mean, you want to make sure it's an accredited,
most definitely,
obviously, but is there anything beyond that?
A charity that's registered with CRA, and it should be fine. If it seems like it's not, a reputable place, then you would likely not want to donate there. Sometimes people will also do a lot of research just to make sure, see how much of this donation is actually getting to the individuals who need it. Sometimes people will look to see, okay, is there a lot of admin? And, if it's large amounts of admin, then maybe they'll want to find a different organization because sometimes some of these admin fees can be quite high.
Yeah, for sure. So in terms of international investing, whether this is through stocks, whether different types, there's obviously different forms that you have to fill in and report. The T1135, that's foreign property. That can also be, that can be stocks, that can be all kinds of things.
Yeah.
Tell us about the reporting people might need to know. Yeah. This has been a huge year for global equity investing, actually, unlike, well, maybe for at least a decade.
Yeah, no, so essentially what happens is if the cost of the investment at any time of the year is over $100,000 in foreign property, then they will be required to do this T1135 reporting. So if it's between $100,000 and $250,000, they're able to do the simplified reporting method. So essentially on the T1135 form, they just check off the boxes as to, so it's very simple, very straightforward. Mm-hmm. If the property has a cost over $250,000.
As in it's worth that much?
No, what the original cost of it was. Then in that circumstance, they have to do the detailed reporting. Right. So much more information is being requested as far as that's concerned. A question we get a ton is with respect to Canadian mutual funds. So a Fidelity fund that's a global fund, do we have to do the reporting for that? It is not required. So this is only for investments that
are outside of
exactly, yeah,
the mutual fund structure.
Mutual funds.
Okay.
Yeah, if it's a U.S. mutual fund, then yes, but a Canadian mutual fund, no.
How would you want to sort of talk about tax loss harvesting? It does seem like it's been such a gargantuan year for gains, actually. Right. So any little tax loss harvesting you could do might be really helpful. It seems to be a November story. We're in December. There's still time.
There is still time, most definitely. And if there is something that's in a loss position, then by all means, they could realize that gain, that loss. And then essentially the loss needs to be used in the year it's realized. Right. Or it can be carried back for a maximum of 3 years and then carried forward indefinitely. Now, one thing that I do always like to mention when I'm talking about tax loss harvesting are the superficial loss rules. Okay. So essentially with this, what it says is if the individual themselves or someone who's affiliated with them repurchases the identical property 30 days before or 30 days after that loss was realized, then the superficial loss rules kick in, and then essentially the loss is denied in that situation. So
you can't just sell it in November and come back in January.
You could sell November and come back in January,
December.
But not exactly. Right. You would just have to make sure you're waiting at least those 30 days. So what one thing that the government has said is that it has to be identical property, and it's been determined that if somebody, sells a corporate class fund and then purchases the same fund in a trust, that's not considered to be identical property. So that's a way to stay in a similar investment, just a different structure, and not have to worry about those superficial loss rules.
What would you say is sort of a final thought? We're heading towards, it's been an extraordinary year for lots of different investors, extraordinarily good in a lot of cases for certain types of investments, but there will always be a variety. What would you sort of hang 2025 as sort of a piece of advice that's either different or the same from most years?
Yeah, I mean, it was a great year, right? Yeah. And as a result, I mean, I think it's just a matter of, looking at clients, seeing what makes sense in their situation. If it is possible to harvest some losses, that would be amazing, right? But just also to be very cognizant of what all of the various cutoff dates are. You don't want a client to not be able to achieve something that they wanted to because of a delay or because they weren't able to get to it quickly enough. So just have those conversations with clients, see what they need, and go from there.
Jacqueline Power, thank you for taking us through what we really need to know each and every year. Really appreciate your time.
My pleasure. Thanks for having me.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. Well, on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.